It's Peter Schiff. It is Wednesday, August 11th, 2010. Well, the Dow is off, I think, about 260 points today, a pretty big decline. Yields on government treasury securities continue to plunge. I think the yield on the 10-year dropped below, 2.7%. And the dollar was very strong today. The dollar index gained about 1.5. We closed at 82.25. Now, I mentioned the last time on my video blog that as the dollar index had gotten very close to the 80 level, I had expected some kind of bounce up around 82. We got that. My guess would be there's not much more to this dollar rally. I think the dollar will resume its descent. You know, the catalyst for the dollar rally was weakness in stocks, basically that started as a reaction, I think, to the statement from the Fed yesterday that they would not allow the balance sheet to shrink. You know, about a year ago, the Fed was talking about an exit strategy because the Fed had bought up all these securities, mortgages, treasury bonds that had ballooned up its balance sheet. And a year ago, it was the exit strategy. How is the Fed going to unwind all this and start shrinking the balance sheet? Now, at the time, and you can go back and read, I wrote an article about a year ago in July of 2009 called No Exit for Ben. It's on the Europac website. And I basically called the Fed's bluff. I said they have no exit strategy. It's just talk. They have to pretend that they're going to exit. But I knew that there was no way that they could shrink that balance sheet because they couldn't sell all these securities without collapsing all the financials that they bailed out and pulling these artificial props out from under the housing market. And now we finally have, a year later, an official admission that the Fed can't exit, that it's going to maintain its balance sheet. Now, initially, the markets reacted positively to that statement, but I think now that they've rethought it, the market was kind of expecting the Fed to come up and say, you know, we're going to grow the balance sheet even more. You know, we're going to buy even more treasuries and mortgages. The fact that they're not doing that maybe disappointed the market because the economic news continues to come out weak. The housing data that came out today, very weak. It's becoming more and more obvious to people that the recession is resuming. Now, I've been arguing that the recession never ended. There was just a brief pause in the recession. It was interrupted by the stimulus. And as we spent all that stimulus money, the recession appeared to be ended, but all we did is postpone it, and we accumulated a lot more debt in the process, and now we are facing a bigger problem than the one that we had before the stimulus. And so as the market sold off, the dollar rallied. Now, it was definitely oversold given how much it had dropped, but people are still assuming that, well, a weak U.S. economy means a strong dollar. That's not what it means. In fact, I don't think the Fed is going to stop at just maintaining the balance sheet. I believe they are going to expand it. They are going to start buying because that's all they know. They've got one trick, and that's printing money. And that's the only arrow in their quiver, and they're going to fire it. Of course, they have to pretend that they're not. They don't want to let that cat out of the bag. But also the news we got today was the trade deficit exploded. Our trade deficit increased. It almost hit $50 billion on the month. It was the biggest monthly increase in the trade deficit since they began keeping statistics in 1992. Now imagine this. We've got a $50 billion monthly trade deficit with really weak growth. With a weak economy. Imagine what would happen if the stimulus was successful and Americans went back on a shopping spree. Imagine where the trade deficit would be then. Would it be 75 billion? Would it be 100 billion? I mean, if we just generate more demand, more spending, but we don't have more production, we just run up the trade deficit. You see, what we really need in this economy is to make more stuff. But we can't do any of that with the stimulus, so all we can do is spend the stimulus money on the products that the Chinese make, or the Japanese, or the Germans, and we run up this huge trade deficit. Of course, the trade deficit is going to subtract from the GDP, and so it shows an even weaker economy. But also, the weak economy means more stimulus, more spending, rates stay lower for longer. All of this is negative for the dollar. Look, this is not 2008. Right? Everybody keeps making that same mistake. They keep thinking it's always going to be like it was in 2008. Well, it's never always anything. And the markets rarely repeat the identical pattern. And just because stocks went down, the dollar went down in 2008, it doesn't mean it's going to do it again. In fact, from watching this blog, I think the opposite is going to happen. Also in bonds, bond prices are rising. Yields are hitting record lows because instead of shrinking its balance sheet, what the Fed said is that as securities mature, some of these mortgages mature, they're going to take the cash and buy treasuries, long-term treasuries. So the Fed is saying we're going to print money and buy treasuries. And of course, treasuries are rising on the anticipation of this demand. But the demand is coming from the creation of money, which debases the dollar, which is what treasuries are based on. In fact, this is really a buy the rumor, sell the fact. These are traders loading up on treasuries because the Fed has said we're going to buy a bunch of them. So people are trying to buy them now to turn around and sell them to the Treasury. But in the long run, when the Treasury is buying treasuries, that's the last thing you want to own. You want to unload your treasuries on the Fed because the money they create to buy those treasuries guarantees that they lose purchasing power. So it's the worst thing that you'd want to own. And of course, anybody that does buy these treasuries, they would have to hedge their currency risk if you're buying them certainly from abroad by shorting US dollars, which is what people will do. And of course, we already have a surplus of dollars in the world from our trade deficit, which is now growing at record pace. If you add to that the demand of hedging exposure to U.S. debt, you have all sellers for the dollar. Who are the buyers? There are no buyers. Again, it will fall through the floor. It hasn't happened yet, but I think it will. And this short-term trend that we're in is still pretty powerful. And look at the yen. Even though the dollar index rose today, because the dollar was strong against the euro, and the pound or the Aussie dollar, it made a new 15-year low against the Japanese yen. And we are dangerously close. If we break below the 80 level, that was the absolute record low we set in 1995, the dollar is in danger of a free fall. Now, I don't think it will happen if it's strengthening against other currencies, but if the dollar is weakening against all currencies across the board at the same time that it breaks below that 80 yen level, look out. And, what is the Fed going to do? Right? The Fed can't keep lying and pretending that it's going to fight inflation, that it has an exit strategy. It will not do that. I mean, we have all of this debt, and there are only two things that we can do because we can't repay it. We could repay it or repudiate it, and it can't be repaid. It's just impossible. We are completely dependent on these low interest rates. The banking sector is. How do the banks make money today? They borrow from the Fed and they loan to the Treasury and they make the spread. What's holding up the real estate market? The lowest mortgage rates ever, and the artificial lending and the support of Freddie and Fannie. What is making our national debt financeable? The fact that it's all financed short term with low rates. This whole house of cards comes tumbling down if rates go up. The Fed knows this, but they can't say it because they can't admit what the problem is. So they have to deny it. But pretty soon, people are going to figure this out, and you're going to see a big drop in the dollar, and you're going Treasury bond prices falling as well. And all of this could converge potentially before this year is over. It might even happen, around the time of the elections, which could be very problematic. I don't know how the politicians are going to spin this, but you have to be very careful about this happening, and don't get caught up in what happened in 2008. And even if this dollar bounce is bigger than I thought, don't be fooled. And even if gold is slower to react, don't be fooled. Because all of a sudden, when these markets act rationally, as I expect them to do, I think the moves will be very dramatic, and a lot of people will be caught in the wrong direction or off guard. So I think we have to stick to our plan that ultimately the course that we are on, this monetization, this stimulus, can only end one way, and that's in a currency crisis and a sovereign debt crisis. And we've got more and more evidence that that is coming from the Fed, from the trade deficit, from the housing numbers, from all the economic data that is coming out right now. Anyway, that's it for today. Take care, everybody. Bye-bye.